Hello everyone, my name is Blaine Pearson and I'm a graduate instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to look at vertical and horizontal analysis of financial statements. Let's first begin with vertical analysis. Now, vertical analysis is simply a fancy term used to describe how items are presented on a financial statement. So, for example, in the case of a statement of financial position, each item would be presented as a percentage of the total assets. So instead of having a dollar amount assigned, we'll have a percentage amount. So we'll take the total assets and then we will, as our denominator, and then our numerator is the asset itself. On statement of cash flows, the same idea, but each item is presented as a percentage of the total income. So, for example, if we have multiple streams of income, instead of presenting the nominal dollar amount, we'll present the percentage amount. Now, here's an example of a balance sheet that we have that takes the denominator, again, as we talked about, this total asset number, which we actually don't know. We just know that all of these percentages add up to 100. So when we're using vertical analysis and looking at it compared for 2 years, we see this all laid out in this nice percentage term, and we can look at it through time. So we can say, okay, well, how did the clients here increase the current assets from this period to this period? And what's great too is we can also take a look at total liabilities as well. And then from there we can work with net worth as well. So what's interesting that I like to use this for is we can look at, for example, okay, well, we can slowly see this brokerage account is increasing over time. We can see how shifts in current assets are happening over time. So what vertical analysis gives us is the tool to not look at just dollar amounts, but see, okay, what are the percentage amounts, which is much easier to use instead of the dollar amount that may or may not mean anything. Now, the same thing with cash flow statements here. We have a vertical analysis that has been applied to a cash flow statement where we're taking the total inflows and looking at, okay, where are those inflows from? And then the outflows, how much of that inflow is derived from that. So we can quickly see as a percentage how much they are spending in terms of their income. So they are spending roughly, these clients in this situation, 20% of their income on personal residence. So again, vertical analysis is this nice, easy way where everything is presented as a percent of the total cash inflow to give us a quick analysis. Now let's shift gears and look at horizontal analysis. Horizontal analysis is something a little different. It looks at each item as a percentage of the base year, then creates a trend over time. So we have in our base year here is 2009. We can look at how the income has increased or decreased over time from the base year. So in year 2014 compared to 2019 or 2009, if the income was $100,000, you'd say, okay, 2014 you made $128,000. Now when the numbers aren't quite as nice and easy to work with and round like that, this is an incredibly powerful tool that allows us to easily quantify and see changes. So look at, for example, the clients here have a golf expense that's increasing significantly over time relative to income. Now, granted, the golf expense may actually be going up nominally, so maybe they went from 1,000 to 1,100, and then from 1,100 to 1,200, etc. So while the percentage terms increase are important to note, note that the nominal amount increases may or may not affect this. But it is interesting to see how the different line items here can be used to compare, for example, income and golf expense, because the golf expense in terms of the percentage of this base year is increasing at a faster rate than income. Interesting point. Again, this is Blaine Pearson, and in this video we covered vertical and horizontal analysis of financial statements.